Hello and welcome everyone. This is a brief video guide on how the trading bandwidth limits operate on Deribit. Deribit operates with trading bandwidth limits in place on all of our instruments. What this means is that there is an upper and lower price limit, a price range in which trades can be executed on any given instrument. For example, at time of writing, the Bitcoin perpetual contract limit is currently set at the mark price of plus or negative 1.5%. So if the perpetual mark price is currently at $10,000, the bandwidth limits will be set at $9,850 and $10,150. For as long as the mark price is $10,000, the traded price cannot exceed these limits in either direction. Functionally, what these bandwidth limits do is stop huge deviations away from the current price of the asset, as defined by the mark price. There are a few reasons why large wicks like that can happen though. A large trader trying to push the price around, a stop hunt for example, an accidental fat finger where a trader mistakenly enters a large order at market and just clears out the order book, or a cascade of liquidations and or stop losses, possibly as a result of one of the first two reasons. Bear in mind though that these are usually just temporary deviations away from the real price. If there was a genuine move in price across all exchanges, then the index would also be moving, bringing the mark price and the bandwidth limits along with it. In this way, the bandwidth limits are designed to only stop unnatural spikes in price and assist in reducing the unnatural price movement that could adversely affect our clients. A genuine move or trend change will automatically be followed by the bandwidth limits as the mark price moves with price. The following is an example of what can, and often does, happen on some sites that do not have any type of trading bandwidth limits or circuit breaker protection built into their system. If the order book is thin and protection is not in place, it's easy for a trader or indeed group of traders to either deliberately or accidentally cause flash crash scenarios. This situation will often be compounded by other traders' stops and liquidations piling on top, causing a cascade to prices that are clearly nowhere near what should be considered a fair price for that asset. As you can imagine, traders that are stopped out anywhere near the bottom in these wicks will not be very happy. They may have suffered heavy losses even in unleveraged positions. On Deribit, trading bandwidth limits stop these kind of flash crash wicks happening. Let's take a look at the UI. On the limit order form, we can see the current bandwidth limits displayed just above the price box. The min sell and max buy are the trading bandwidth limits. In this example on the ETH perpetual, you can see they are set at $229 and $236 respectively. What this means is that unless the mark price moves, no sells will execute below $229 and no buys will execute above $236. Please note, however, that it is still possible to leave a regular limit order outside the bandwidth limits waiting for the price to move there. For instance, in the above example, it is still perfectly acceptable to leave a limit sell order at $400. If this price moves up to this price naturally, it will bring the bandwidth limits with it, allowing buy orders to execute into the limit sell order as normal. Much like the futures trading bandwidth limits, the options trading bandwidth limits are displayed as a min sell and max buy on the order form. These figures are located just above the box where you can enter the price in BTC of the option contract, highlighted here. In this example, we have BTC 27MAR20 10,000C, that is the Bitcoin $10,000 call option that expires on the 27th of March 2020. And the trading bandwidth limits are set to 0.0145 and 0.057 BTC. This means that no sell orders will execute at a price less than 0.0145 BTC, and no buy orders will execute at a price more than 0.057 BTC. As with futures, the option bandwidth limits will move as the mark price of the option changes. For example, if the underlying price of Bitcoin fell, so would the mark price of call options, bringing the bandwidth limits or possible order execution price range down with it. Market orders will attempt to fill the order at the best possible price, moving deeper and deeper into the order book until it is completely filled, without consideration about the price it eventually reaches. The primary directive is for the order to be matched. So what happens when a market order that is attempting to fill at any price runs into one of these trading bandwidth limits, which stop orders executing outside of a certain range? The market order is saying, I need to fill and I will take any price, and the bandwidth limit is saying, you cannot execute at this price, it's outside the allowable range. When this happens, a limit order for the remaining quantity will be placed into the order book at the bandwidth limits waiting to be filled. This way, it still obeys the bandwidth limit rules, but also gives the traders full order a chance to fill, on a price throwback for example. This market order with protection helps to reduce counterparty risk and therefore protect our clients from socialized losses. You can read more about this in our article on market orders with protection. A link will be in the video description below. Let's go through an example. Imagine with our earlier Ethereum perpetual example, you tried to place the following market order for $3 million. Now remember the bandwidth limits at the time were $229 and $236. As you can see from the order book, a $3 million market buy would take the price well above the upper bandwidth limit of $236.9. What would happen if you submitted this order is the order would execute against every order right up to the bandwidth limit, which would total up to roughly $2.3 million here. Then a limit order for the remaining $700,000 would be left at the bandwidth limit price of $236. This limit order can be left to be filled on retracing price action, or cancelled, and the trader can decide what to do with the remainder of the position, even remarket order if they wish. Please note that when viewing the order history for a market order, the price field will reflect the bandwidth limit for that order. However, the average price field will show the average filled price. For a limit order though, the price field is constrained to the limit order price. These bandwidth limits, the min price and max price, can also be seen on the API with the public ticker endpoint. In summary, the bandwidth limits are important for protecting traders from unnaturally large price spikes. They offer protection from large and isolated deviations that are not being replicated elsewhere. The bandwidth limits are not static and will move with the price, allowing regular trading to continue within the normal range. For the options, they also help prevent mistrades, whereby a trader accidentally sells an option for a tiny fraction of its intrinsic value. Traders on both sides of the market are offered peace of mind, knowing they are trading in an environment where the exchange has measures to prevent extreme price action, opposed to exchanges that do not have any of these protections. This was a brief summary of the trading bandwidth limits on Deribit. Thank you very much for watching.